Good morning, everybody. Welcome to the Flow Show. Bit of a livelier day so far than we saw yesterday. Morning, Kay. Morning, Stel.
Good morning.
So that was that. You could have played a joke there and gone silent, and then you would have caught me out. But you missed your opportunity. How you doing, Kay? You all right? Finished?
Man.
Finished Uber driving?
What was supposed to take me an hour and a half, an hour and 45, took me 4 hours yesterday. There was an accident not far from where I live, and we got stuck in traffic for hours.
Oh, nice.
So yeah, I'm actually feeling knackered. I've done enough dad's cab driving of late. Not for my age anymore.
And you don't get paid for it either.
No, on the contrary.
Costs you money. Right, we've got a good show today. We're going to take a look at cross trading after we've got through the first part of the show. So let's get that out the way first and foremost. Tons of data out already overnight and today, so that's where we'll start. Just try and do a brief overview of all the data, and then I'll knock out the headlines. Right, so here we go. Unemployment rate in Japan stayed unchanged, 2.5%. Seeing a bit more weakness in manufacturing and industrials there, with the industrial production number coming in a little softer. Not as soft as expected, but still a negative there. Retail sales, Japan seemingly one of the few countries posting decent retail numbers for December. It's pretty dire elsewhere. A nice rise of 3.8% there, and large retailers also posting decent gains on the month from those numbers. Coming over to today, and some data out of Australia, mainly this retail sales number, a bit horrific at minus 3.9%, much worse than expected, down on last month. Chinese PMIs out, manufacturing moving just about into expansion there, services a decent rise there. That could be in part due to some of the reopening coming out of lockdown. The holiday period is probably not included in those numbers because that was only last week, of course. So maybe we see those numbers jump again next month. Over to Japan, construction orders up, decent number. Household confidence gaining yet again. Housing starts a little on the softer side, but as I'm saying, we've seen a bit of divergence between the sectors there, but consumer confidence or household confidence, probably the main number from that lot there. A load of GDP, CPI and retail readings this morning from Europe. Consumer spending not looking good for December, matching what we're seeing elsewhere. GDP coming in at a plus number. A lot of people expecting many countries to post negative numbers coming into the final quarter, but a miss on what was expected here, but it's round about the ballpark of what was expected if you take all the calendars into account. German import prices falling not as much as expected, seeing some steep declines there, and still falling, but not as much as expected. Year on year down some as well, again not as much as expected, 14.5%, prior coming in at 12.6. Retail sales a healthy minus 5.3% there versus 0.2 expected. Switzerland retail sales also coming in. You're getting the theme here now. We've seen the same from the UK, from the US. A lot of countries having a very poor holiday period. No, it was November and December sales not looking good at all. Bit of surprise for French CPI, perhaps was expected to jump to 6.1%, only came in at 6%. Still, it's bucking a trend a bit because it's a rise on last month. Same with the HICP, the Eurozone measure, coming in at 7% as expected, but confirming a jump from 6.7% prior. Peak inflation, do you reckon? Who knows? These numbers suggest maybe not. Unemployment change from Germany down 15k, was expected to go up 5k, so Unemployment rate staying unchanged, numbers round about as previously, so not much to take from those. Italy unemployment staying unchanged as well, 7.8%. Over to the UK, mortgage data from the UK showed a quite steep fall in mortgage approvals. Now, this can be affected obviously by the time of year. Coming into a short month, no one's going to be getting mortgages while they're eating their Christmas turkey. However, this is the lowest number for some years, and the decline, the trend lower, is very evident. One of the other points I look at is the BOE consumer credit to see how consumers are faring. Are they racking up debt because of the cost of living? Doesn't seem to be the case. December, a month where you think things might ramp up to pay for stuff over the holidays, and in fact it missed by quite some margin. And I also look at the credit card spending part of that, and there's no red flags either coming there, something we've been watching. So generally looks like just there was a lack of spending, a lack of borrowing by the consumer, particularly in the UK in December, which tells a story in itself. Is there a lack of money all round? Is inflation biting and people are just about paying for what they need rather than going above and beyond? Looks to be the case in a lot of these readings here. More GDP, Italy as well, not as bad as expected on the quarter, down 0.1% versus minus 0.2 expected. And Greek retail sales, look at that, Stel. You've been out buying cars again?
No comment, Your Honor.
Well, you did have to get, what was it, your gearbox fixed, so that's probably that 0.9% there.
Maybe, yeah. No, but seriously though, the trend in retail sales is low everywhere, and the problem is that they're not inflation adjusted numbers. So if you see a flat reading in retail sales, that means things are bad because the stuff that people are buying has become more expensive. So you need to see the number growing by roughly the inflation rate to say, yeah, no, things are okay, but they're not.
Yeah, exactly. And it's, you take something like Germany down, what was it, 5.3%? That's a big number. That says that the actual spending is slowing, irrespective of inflation. And that's the other side you got to look at. Inflation, as we said, when you're paying more for the same stuff, even if that gives you a positive number, it still means people are forking out. It's when they can't afford what they were buying previously, that's when the problems arise. I don't think we're there yet, but we could well be heading that way. And yeah, as mentioned, Eurozone GDP as a whole, the flash of the reading, coming in a surprise 0.1% versus minus 0.1 expected. So potentially ending the year on a slightly better note, shall we say. Just looking ahead quickly at the data today, this CPI data isn't coming because according to German Stats Office to Statis, they've got problems, technical problems with data processing. So they will be postponing the release of this.
They can't
CPI.
find the negative sign, basically.
Yeah. the key's not working on the keyboard. Lots of people saying obviously they want to fiddle the numbers so it fits in with their narrative, but who knows? These guys and the ONS at the UK and all the rest of them, they've all had issues recently with data processing. Who knows what happens? Anyway, the Eurozone will be coming out with its numbers. I think that's tomorrow, and they'll be estimating the German parts of that. So wet finger in the air for those. So that's the data run for that. We have got Canadian GDP coming out as well later today, some house price numbers. US consumer confidence could be a decent number to keep an eye on, also containing inflation expectations, particularly obviously with the Fed tomorrow. So some important numbers coming up there. While we're on the inflation front, UK Kantar says that grocery price inflation has hit a new record at 16.7%. So as far as groceries is concerned, that inflation metric still rising for the UK, not going down. And the UK is got or is going to have some very steep secondary inflation risks coming into it. Wages from strikes, all that sort of thing still ongoing. As we can see there, grocery prices still rising. Peak inflation, I wouldn't start calling it yet for the UK particularly. Rishi Sunak said there's going to be no more tax rises, and that's where we are with taxes at the moment. We cannot put them up anymore, and we need to be getting them down. You might have thought that might have been a bit of a lift, giving the pound a bit of a lift on that news that no further taxes are coming, but no one's really paying attention to what he's got to say at the moment. Going back to China, and the SCMP was out with a piece saying that Taiwan warnings show that the US military is preparing for war, according to Chinese analysts, and that the risk of conflict between the Chinese and US militaries has increased as both sides boost deterrence capabilities, according to experts. Chinese Foreign Minister Gang wants to set up a China Gulf free trade zone as soon as possible, and is going to be speaking to his Saudi Arabian counterpart. Some moves there from China diversifying where they're going to be doing trade. Japanese Finance Minister Suzuki said that both the government and BOJ see the importance of wage increases, but it's too early to say whether the joint statement needs revision. We've been speaking about this. It's the Bank of Japan framework as agreed between the government and the BOJ. Lots of talk as to whether that gets changed, primarily on how they talk about inflation as a target, whether they move it to something more longer term or change it around any other way. Still a discussion to be had. Over in the US, President Biden is going to end COVID emergency declarations on May the 11th. So further moving COVID into the rear view mirror over there. That's all I've got on the headline front. Unless you boys and girls, or you boys, should I say, Kay and Stell, have anything to add?
No,
no.
not from my side, mate. I'm still catching up.
Yeah, cool. No problem at all. Okay, we'll have a quick look around some of the price action going on at the moment, and then we'll have a chat about crosses and stuff, and take it from there. So, bit of a dollar bid this morning. It's all looking a bit risk offish, generally around the grounds. Commodities are down, oil's down, gold's down, other metals are down. As I say, dollar looking well bid. We still have end of month stuff. I'm not sure what's shaking the tree here. Maybe these retail sales numbers coming in and hitting. We've had the IMF sticking their wet finger in the air and giving us some forecasts for this year, which are showing things not to be that great, particularly for the UK. But you boys and girls know what I think about forecasts. What's shaking the tree at the moment, guys? You got any thoughts?
Apart from the data today, I just think it's position squaring. I don't know. Tomorrow's FOMC is super important, and that's because we are fully priced at 25, and really there's no margin for another outcome. A no change or a 50 without the markets going a bit ballistic. And is it people kind of trying to limit their risk going into tomorrow? And I don't know. I actually don't know. But the numbers definitely are not good that we're seeing today, the data. But I wouldn't say that it's something that really should be driving the market, at least not ahead of tomorrow. Data today is going to become irrelevant. It's all about tomorrow. So I'm not sure. What do you think, Kay?
Well, I think, yeah, it's what you said. I mean, there were those important levels. When I look back yesterday, when I wasn't in, euro dollar tried again above 109. It's again refusing. Cable above 124, refusing. Aussie dollar towards its highs, refusing. I think the market, yeah, it's trying to prepare the central banks, the FOMC ahead. Then we have like the big NFP report, and it's all gearing up to be a big week for the dollar and for other currencies, of course, because we got ECB and the Bank of England. So yeah, this also, so I think it's a bit of a combination about preparing for the FOMC and a bit of technicals, and then today we could have a bit of flows going on into the afternoon fixings, also perhaps the morning fixings a little bit, but it's been relatively quiet on the morning fixings. So yeah, basically the models are calling for a slightly weaker dollar, but I would yeah, I don't think I'm going to trade much of it. I think if there's one currency outstanding on the models, to me at least, it would be sterling being a little bit better bit than others, perhaps because of the differentials in the equity markets. But I don't know how much bonds are going to influence, so I'm not going to trade too much of it. But what I would do is that if we see some downside on the euro sterling on the fixings, I'll be a happy reloader of some more topside options, because I think the divergence between ECB and Bank of England this week could get a bit bigger. And also the data are relatively supporting this euro sterling view. But we'll talk about those crosses.
Yeah, Aussie dollar is one that's looking a bit weak. As I said yesterday and last week, watch this line here. If we break and hold the break, then we're heading down probably towards the big figure, maybe even down to 69, 50, 60-ish. Technically, it's done exactly that. It's broken and immediately found it as resistance. And that's a signal. And here we go down, and we're breaking the big figure at the moment. I was long a little bit off this level here. I got stopped out overnight on the balance. Well, I was long on this portion here, knocked some out all the way up here, got done on the balance. I am in a scalp long here, which I've taken a few pips off, but I'm long 7006, and it's not looking too hot, so I'm going to keep an eye on that while we're talking. It's always a bit difficult when you start breaking ranges when you've got big data and big events coming up, because it can get a bit dangerous, because you think, okay, that level might hold, that level might hold, and then you find out it doesn't. If the market is doing some positioning around the events coming this week, then likely your technical levels aren't going to stand up to much. Hence the reason why I'm not doing anything big. I'm just doing a bit of sniping. I'm not going to be sitting in any positions that go against me for very long. I will try picking bits off, but if they don't work, they don't work. I'd rather lose a few pips being wrong than lose more pips holding on to a trade, hoping it comes back. So keep an eye on that. You know, dollar yen, still not really doing anything. We're still mooching around 129s, 130s, not really going anywhere. So despite what we're seeing elsewhere, nothing really happening in this one. I will be keeping an eye on this 131 zone, potentially if we get a move, but we are a veritable 5 minutes from the FOMC, so that's going to feature. Again, I'm going to be more reluctant to trade. Dollar CAD as well. You know, this is another one. Been watching the one, or waiting to watch for a move to 135 for a potential short, but again, looking at the clock, I'm not going to be that interested in trading that if we're only not long until the FOMC, because anything can happen. It can be 138 or it can be 132. Who knows? Always looking at the risk part of the trade, and do I fancy playing with that risk in the interim before these meetings? So that's a quick overview. Let's have a look at some of the questions before we get into the other stuff, because we are looking at it. And Mike, you've got a good point there on trading crosses like dollar MEX, and that we'll have a look at as well. Gold, someone's saying have a look at. So finally, looks like it's making a move back lower. Again, it's coming amid a bit of a commodity easing. I say it's looking risk off around everywhere at the moment, just from what's happening there. Silver, which I'm sure the guys here will touch on in a while, also looking a bit softer as well. So generally the theme here in the market is that commodities are lower, as shown. Oil as well coming down, testing the trend line. It's not a trend line I'm overly keen on, but you know, tech's a tech, so we'll keep an eye on it. I think the break under 78, 77, 80 is potentially the key there. If we hold below that, bit similar to Aussie dollar, that's the area you need to look at if we get any bounces. But we're right, testing that trend line now. Under there, we may be heading back towards Biden's favoured bid zone, down towards the low 72s. So again, a bit of a risk parameter shown from this one. Right, let's talk about crosses then. Why do we look at crosses? Why do some of us trade crosses more than others? A lot of people are probably pre-programmed that the dollar is the main currency in the world, which it is, and therefore it should be the one that's always traded. But that's not necessarily the case. There's obviously loads of other different currencies. You can cross up any currency you like, but you have to know how crosses work, what they do, how you trade them as well. And there's really probably two main things you need to learn when trading crosses as a good background. The most important is liquidity. Okay, there's a cross for everything. Obviously, you can trade one currency against another, but liquidity in that cross is probably the most important thing you need to be concerned about. Because if there's no liquidity in there, it's going to be difficult to trade. You're going to get wide spreads. You're going to get choppy moves, volatile moves, because there isn't the market in those pairs as there are in the majors and some of the bigger crosses. So liquidity is probably the number one thing you need to concern yourself with. The second thing is proximity. You know, you can cross up any pair you like, different countries, but the ones that tend to be strongest are the ones whose countries are in close proximity, like Eurozone or Europe and the UK, like Australia and New Zealand. And the main part of that is because they are closely interconnected economies, a lot of trade between them, and so therefore you get a lot of flows, and that also is part of the liquidity consideration. Now, under that, you have other things you can look at. There's things like the carry, like Mike's pointed out there. You know, crosses tend to be less volatile depending on what the crosser is. You know, you take euro sterling as a particular example. You know, here we are going back a year or so. We've had a pretty tight range, you know, 500-600 pips, and that's top to bottom. You get periods where it sits in calm ranges, you know, 300-400 pips. So on that side, you've got lower volatility, and you can trade the flows between them. Now, on some pairs, you have, as we said, the carry. If you get a perfect pair, where whether you're long or short, the carry pays you money to sit in it, and it's a fairly low volatility pair, then investors can earn their money just sitting in a pair and not really caring what side it is, as long as it's the right side for the carry. And then lastly, obviously, the technicals, they apply in crosses the same as they do everywhere else. And sometimes they can be a bit stronger, again, because of the liquidity. If everyone's looking at a moving average or a fib or something like that, you know, it's not going to take as much money to hold that line if a lot of people pile in against it. So from these things, you know, the end of the day, you can trade anything. Okay, if you've got the basic foundations for trading, managing risk, knowing how to enter a trade, where to put your stop, whatever, it doesn't matter what you trade. Okay, trading is just guessing whether a number goes up or down. Doesn't matter what the asset is. So if you've got the basics for trading it, you can trade anything at all. Doesn't matter whether you've never heard of it. You can trade it if you know how to trade properly. The fun part is then understanding the asset, how it moves, how it reacts, what are the drivers behind it, what is going to move it somewhere new. And again, you can do that for every pair, but in the crosses, it can be more specific. And we're going to be having a lot of that this year because of the divergences between central banks. It's not going to be everything versus the dollar this year, although it's going to be a big driver. We're going to have splits between the Eurozone and the UK. We're going to have splits between the RBNZ and the RBA. And those are going to give us some decent volatility to trade in the crosses. So I'm just going to bring in the other lads. I don't know who wants to start first. I'll throw some questions at you and you can give me your thoughts. Liquidity, how important is it?
In general, liquidity can make the difference between a successful and a failed trade. So it's very important, especially on crosses that are not the liquid ones, the ones most actively traded. You can have issues. I remember when I started trading the Noki years ago. It was a big old bid offer, and it was difficult to get good fills on trades. So liquidity for me is important because you can give away a big part of your potential stop. Basically, you say I'm going to enter here, stop there. Well, you give away a big chunk of that potential loss on your entry and on your exit as well. So it's you have to remember the exit as well. It's my opinion, liquidity is really important, especially in the weird pairs, let's say.
Yeah, exactly. How about you, Kay? How important is liquidity in a pair to you if you're trading across?
Well, I mean, the first thing is that for us retail traders, the liquidity doesn't really matter because we are very, very small fish in the market. But I understand what Stelios means by liquidity, and then there on that side of the equation, the liquidity is very important, as Stel just said, because you can have like wide spreads between your entries and your exits. Also, good example are the Noki, the Stocky, some of those. Let's say not the majors who tend to move quite a lot and widen out quite a lot as well on data. So so it's a twofold. So first of all, if we talk about liquidity in the sense of are we going to be able to do a trade, for us it doesn't really matter because we are not like BlackRock or whatever who comes in the market with 1 or 2 yards of a currency pair and has to worry about where the execution will be. But for us, it's more a fact of take into account where most of the time where you get out, because if you get out on a stop or even a take profit when it goes massively your side on a data point, it could turn out to be very bad. I recall, and that's typical for the retail platforms, when I had the dollar yen in over the pandemic. First of all, dollar yen shot up, and I entered an option trade on a dollar yen call on a 4 or 5 pips wide trade. But when the pandemic broke out and when the shit hit the fan, all of a sudden they were quoting me 60 or 70 points wide, which is costing like basically the whole spread or the whole profit on the trade. So when you trade lesser liquid currencies, lesser liquid and currencies who less of the important ones, you have to know that sometimes prices can get wider. That's one thing. That's the other side of the liquidity, which indeed we need to take into account. But then there's other sides as well, of course. But you were asking about the liquidity.
Yeah. So okay. So what about proximity? Trading a Brazilian real, Polish zloty cross isn't going to be one of the best pairs to trade in terms of proximity or indeed the fundamentals. And you have to look at trade between the two different countries, if you like. Is it strong? Is it weak? So how important is proximity? For example, your euro sterling, your NOK SEK, and that sort of stuff.
Well, yeah, go ahead.
So I was just going to say, for me, that's purely a function of what kind of trade you want to take on. If you're looking at a technical or, you know, short-term trade, I don't think that matters. You know, it's you look at these kind of things if you're looking to take more directional views, more macro views on a certain pair. You know, if you're looking at something on a purely technical from a purely technical perspective or something like that, or if you're looking at a 1 minute or a tick chart, you know, it doesn't matter at all, right? So it is important, but only if you trade, you know, like me. You know, I don't. Well, up until yesterday, I wasn't day trading. Apparently, I've started to do that as well. But yeah, that's my view on that.
Okay.
Yeah, I think it's relatively important for some crosses, like for instance, that you need to differentiate, right? Stuff like Euro Scandies, they are going to be very closely linked to each other. Euro Sterling is going to be very closely linked the two currencies to each other. Stuff like Aussie Kiwi. And then you start to widen the horizon a little bit. But if you the one thing that I should really point out before even talking about anything else, you need to know what you said in the beginning, Ryan. You need to study a bit more about the interconnection between the economies in when you start to trade crosses, because it's going to allow you to get the subtleties between the two, and there's good in trading crosses, because you take away everybody, as you say, trades the dollar, but there's a massive amount of noise when trading the dollar, and as I say, moves that come out of nowhere for not too many reasons, just positioning because everybody is in there. Sometimes crosses can be cleaner than what you do in the dollar, because there's a bit less noise involved in it. So, for instance, you was talking about Euro Sterling, which is nowadays, since Brexit especially, probably one of the closest knit crosses, one of the closest things you can find as a cross, apart from the Aussie Kiwi, probably. And so if you cut out you cut out all the dollar noise, and but you have to know how the UK and the EU are interlinked, not only Brexit, but on a global trade basis as well. And if you understand all of those subtleties, then you overlay your study with what the texts are telling, and it allows you in crosses also. What I found, despite not having an overly big view on what's happening in the dollar, for instance, at certain points in time, it still allows you to keep cross positions, because they filter out some of the noise, you know, that we have in the dollar, for instance. Or if you would trade pairs like euro dollar or cable or dollar yen. So yes, I think for me the proximity is important, because I do trade quite often Euro Sterling, I do trade Aussie Kiwi, I do trade the Euro Scandies. For instance, if you do, I haven't traded Euro Stocky for a while, but if you look at it, the Eurozone is the biggest trading partner of Sweden. So if you look at the Euro Stocky, you have to know what's going on between Europe and Sweden. Of course, you can trade just text, but I always like to know what I'm trading, you know.
Yeah, no, exactly, mate. And I think that's an interesting point you make as well. You know, crosses are not often risk currencies. So like today, we're seeing, you know, the dollar fairly well bid against a lot of pairs, but Euro Sterling's doing nothing. You know, cable and Euro dollar can both drop, you know, 100 pips each right now, and still Euro Sterling wouldn't do an awful lot. Obviously, there's going to be a little bit of a drag, but largely it won't do anything. So getting out of the noise is one of the reasons why you look at crosses. But you know, as people said in the comments, Angela says, euro sterling moves trends better when the dollar is consolidating. Well, if the dollar's consolidating, what do you mean move better? It moves higher or it moves lower? Which way do you think it goes? It moves higher. But yeah, that's part and parcel of the pull and the difference in volatility between the two. And cable and euro dollar are an interesting case in point, because there's always a bit more volatility in cable than there is, or the pound, than there is in the euro. So if something happens, dollar rises, cable might come down 40 pips, euro dollar might come down 20 pips, and then that's going to be reflected in the cross move. You don't need to have a huge understanding of two economies to trade the crosses. Just the basics, just knowing what the central banks are doing. That's been clear in recent moves in Aussie Kiwi. The RBA getting that surprise inflation report. The Kiwi also showing that inflation wasn't going down as quickly as well. But what did we see in the cross? We saw the Aussie side of it gaining more than the Kiwi side, because we knew what the RBNZ were doing. This was potentially forcing the RBA, who were slowing and maybe coming to a pause, to maybe not slowing now. So you don't need to have the economics degree to trade anything. You just need to know the basics, what a central bank is doing, a rough idea what the economy is doing. And then if there's any changes to that, that's what happens in the currency. And the same you factor into the crosses as well. So now the RBA may have to get a little more hawkish than they were before, but there's no real change to what the RBNZ were doing. And on that basis, that's why the Aussie got bought that time. So the fundamentals are important. The technicals are important too. And what about the carry then, guys? Do you trade crosses purely on the carry, or how much does potential carry influence the way you might trade a cross?
I just want to reply to this euro sterling thing about cleanly moving, and Bernard Meyer asked a question in the Q&A, which is kind of linked to that. There's a subtlety about euro sterling, that comes down to liquidity between different pairs. Because if you look at euro dollar and cable, for instance, euro dollar, there's still a lot more liquidity, so it's going to be a little bit of a slower mover. So in general, when the dollar goes up, and so euro dollar coming down and cable coming down, cable is probably going to be a little faster, and the euro sterling has a tendency to trade a little bit higher, and vice versa. When the dollar is sold, euro sterling, if you only take that into account, there's a lot more to take into account, of course, on the fundamental side. But there's this little it's not a trick, but it's something that you will note, that if the dollar goes down, euro sterling, and nothing else happens, all else equal, euro sterling has a tendency to be a little bit heavy, just because of the speed of the cable. So you were asking about, Ryan,
the carry side of things.
Yeah, I do it a lot, right? I've been trading it a lot, especially on the Mexican peso, and especially and for two reasons, right? So first of all, there's a massive carry that you get if you're long Mexican peso. So it's a 10% interest rate currency, and if you look at the euro, it's still only around 2.5 or whatever, 3%. And so you still have a lot of difference. You can also do, for instance, Mex yen or so. So if you have it long enough in position, and the global economy or the global risk pattern doesn't change much, you are usually going to benefit, because you're not alone in this trade either. A lot of money managers around the globe do have carry trades on, because if nothing else moves, it's kind of free money, and people do like, whether it's a retail trader or whether it's the biggest asset manager in the world, they do like a bit of carry, because it gives you money, it gives you money just to be in the position. But there comes a bit of a, then you have to know what's going on the the one who is benefiting from the currency, who is benefiting from the carry, needs to have some kind of decent fundamentals. And for the case of the MEX, for instance, if we've seen since the pandemic, since the issues with China and everything, there's money flowing back into the Mexican peso, also thanks to the proximity of the United States, thanks to the USMCA deal. The MEX has this potential of attracting flows and investor flows, contrary to what you just showed on the Turkish lira, where Erdogan is doing his utmost best in the past 4 or 5 years to kill the Turkish economy. That's one where you
and Greece too.
Stay away. But Greece, you're still in the euro. We bail you guys out all the time. So I mean,
no, I mean literally, they want to invade us. No, I'm kidding. Don't worry. He threat every time there's domestic trouble, he always turns towards us and says some big words and threats and stuff. But
okay.
Yeah.
On that side, absolutely. It's a bit it's a danger zone over there. So that one is one that I'm leaving alone, gladly alone.
The reason why I highlighted the lira yen is because remember the flash crash? Was it 2017 or 18? I can't remember. Remember that New Year's flash crash?
Yeah.
It started in this pair. And the reason it started in this pair was because a lot of Japanese investors were playing the carry in this one. It was a huge carry trade. I can't remember what the trigger was, but that was the one that sent that New Year's flash crash happened, started in this pair purely on the back of a carry trade. So it just shows how big this carry trade can be. And it is big in Japan, isn't it, the carry trade?
Big in Japan, yeah.
Yeah, very much so. There's two. So Japan investors look at, let's say, the three major, and they look at other stuff as well. But the three major ones will be, first of all, they are the biggest investors in dollar instruments. So the dollar yen will be the main instrument of choice. But then you have behind there, you will have the Aussie yen. And because they have a big trade relationship with Australia as well. And Australian interest rates have always been higher than Japanese interest rates. So part of the carry trades, what the Japanese investors do, what Mrs. Watanabe does, will be in Aussie yen. And then the third one, historically, right? And there's others. It's a non-exhaustive list. But the third one will have been euro yen, but that's more trade relation and the depth of the market, a bit of diversification out of the dollar. But I can imagine that nowadays they must be pretty heavy in MEX yen as well, unless they are at home for now because of the yen strength, which has strengthened 15-20% over the past 15. Over the past couple of months, they may have been stopped out of a few, but I can imagine that stuff like MEX yen attracts their attention as well.
Yeah, exactly.
My guys, my view on carry. Very, very quickly. I think carry is hugely important, especially in times when volatility is relatively low. So for the last year, carry has become less important, but the ability to put on a trade that pays you, and some trades, it's decent carry, right? You get something like for the MEX, and there used to be the Norwegian kroner as well at some point. And I'm not going to talk about Turkish lira because that's just a gamble, in my opinion. But if you get paid to hold a position, that's for me, it's good incentive, especially if I believe in the trade and if volatility is not ridiculous. Obviously, if volatility is high, then the carry you get can be lost within a day. But for me, it's just another thing that I look at when I try to put on trade. And I'll tell you this: I have refused trades sometimes when carry is not good. So for me, I don't know if I'm different to you guys, but for me, carry is a very important part in consideration.
Yeah,
no, I fully agree, mate. I think, and also what's important if you do carry trades is don't look at, of course the techs are important. They are always important in whatever you do, but don't look at a carry trade for a day-to-day trade or whatever. If you decide to enter a carry trade, there's two things to do. Either you take the position and then you put wide, and you're always going to have to be wider than you look at wide techs if you want. Or what I like to do, like for instance, stuff that I've been in for long time, is like I just tend to build up positions, and then you look at indeed stuff like risk, stuff like geopolitics, depending on where you are, but they can work actually in favor of a carry trade. Like for instance, MEX, its geopolitics were looking in favor because in addition to high interest rate, it had its far from my bed safe haven status because they were not affected, or not as much, by the Ukrainian war. Perhaps in contrary, it actually MEX actually benefited from it. So those are the things. But then you have to be prepared to let it move, to let it wiggle a bit, to let it do its thing, and then stay long enough in it. If the moves are not adverse, stay long enough in it to really start benefiting from the carry as well.
And just for people who might not be 100% sure, so the carry trade is basically the difference between the two. You know, you take a trade, it has two legs, right? Two countries, two pairs. There's a difference in the rates of one country to the other. So you do a dollar MEX when the Fed had rates at 1% and Mexico was at 8%. That's the difference you get paid if you are short the pair. So you're borrowing dollars and you're buying, you're taking in so you're basically, you are borrowing in dollars and lending in MEX. So this is a difference that you will get on a daily basis, right? If you have this trade with a broker, or however you have it, you're going to get this daily adjustment of your P&L, obviously the other way if you're long that pair, just in case people are not 100%.
Yeah, I was going to embellish on that as well, because I can see I'm maybe 10,000 miles away and sitting on my computer, but I can see Brand's cogs turning in his head when he says paid to hold a position. What does that mean? The carry is, crosses aside, the carry is something you have to be aware of. The cost, it's part of the cost of trading, okay? And as Stel says, you have an interest rate for each country and then therefore an interest rate for each currency. So if you are long or short, you are effectively holding, or you're minus or selling, you're negative a country's currency. Therefore, you are plus minus the interest rate. And obviously your broker likes to put his little bit on top of that. So, for example, euro sterling, my longs that I took last year and was holding through the year, the cost of holding that trade was mounting up. It was doing nothing. In the summer, it was doing nothing. And that's one of the main reasons why I got out, because I was just giving money away to the broker, okay, because it's costing me to sit in a position and the position's doing nothing. And so you have to factor that in. Now, usually it's not prohibitive if you're trading in and out, short-term trades or whatever. But if you're sitting in positions for a while, you just need to keep an eye on it. It's called swap. Most of the people will know it as swap, okay? That's the difference, as Stel pointed out, between two currencies and whether you are earning or paying. So always keep an eye on your swap, particularly if you're sitting in a trade for a while. Is it eating into your profits? Because you can well find you're in profit pip-wise, but you're losing money because it's costing you to hold that position. As a flip side, as the guys have said, if you're looking for a carry trade, it's not I'm going to buy this, sell this with a 50 pip stop and earn money while it's doing nothing. That's not the way it works. A lot of investors who get into carry trades are scaling in, or they're positioning at the start of a year, they're managing it. They're also hedging it as well. They may be hedging it via options and whatnot, taking advantage of the price moves. If the price moves in their favor, they may hedge the actual position to lock in some of that price move profit, but not giving away too much on the carry side. So if they do move offside, they've hedged some of that as well. But it's not a one trade. Oh, today I'm gonna get in dollar MEX because I fancy earning a few pips on the carry. fine. But, if you get a 1% move against you, well, now you've got to sit in it quite a while, perhaps, to get that 1% back if the price doesn't come back. So it's not a definitive, oh, I want to earn some money sitting in a trade doing nothing. You've obviously got the price move risk on that as well. Well, you guys got anything you want more to add on the cross side of things? And if any of the viewers have any other questions, please feel to throw them in, and we can obviously talk about those as well.
Just to answer, oh, sorry, were you gonna say?
Go, mate. Go.
I just wanted to answer. One of our friends asked, carry depends on position size. Well, carry is in terms of an FX pair, it's a differential of 2 interest rates. So this is a percentage. Obviously, if you have 10K on a position, your carry is X amount of dollars. If you have 100K, it's 10 times that. So it will depend on position size. If you're talking about the absolute profit, yes, but it's a percentage, right? Anyway, so carry on, Ryan.
No, that's cool, mate. I'm just going back to a question someone was talking about. So it was Mike, an experienced Canadian trader, was complaining that the dollar CAD still confused him because it often or doesn't correlate with the stuff. Yeah, well, that's a separate thing. Correlations, is a separate thing altogether. We know dollar CAD can be heavily correlated with obviously what the Bank of Canada is doing, the economy is doing, but also oil. But what happens when it doesn't correlate? Then you have to take a different angle to it. And dollar CAD has been a pair of late that, I've not had a handle on it. Is it on the oil bus? Is it not on the oil bus? What's the drive? Is it the dollar driving it? What is really driving this pair? And when the correlations break down, then you have to acknowledge that and say, right, if I see oil spike, $5, but I don't see dollar CAD dropping, then the correlation isn't working. So I'm not going to look at oil too closely to see what dollar CAD's doing. But then at some point, you've got to trade the pair on its own merits, because if you're looking at oil too much to trade CAD, trade oil. If you're putting that much effort into watching what oil's doing, trade oil. Don't worry about what it's doing for CAD. So you have to treat each pair on its merits. And again, that comes into talking about crosses as well. There's times when we may see euro dollar and cable moving, and they may move significantly, but all of a sudden that's pushed euro sterling to a big technical level that everybody's been trading. And it could be people who are in euro sterling trading against that big level actually stop cable and euro dollar from moving, because it's all interlinked. So you always have to look, crosses, you may think of the smaller pair and it's the majors that drive the cross, but there are times if the cross hits strong technical resistance or a level where, the price is going to do something, it can actually put the brakes on what happens in the majors. So that's another subject to do with crosses. You can watch the crosses to get an idea of what's driving what. For example, if you see dollar yen rallying higher, well, you look around, what's happening in the dollar side? You look at cable, you look at euro dollar. What's happening in the yen side? You look at euro yen, you look at Aussie yen, and you find out what the driver is. And sometimes then you can get the picture. Okay, dollar yen's rallying 100 pips, but all the other dollar pairs aren't doing anything, but all the other yen pairs are moving as well. Then you can identify, well, this is actually a yen move, not a dollar move. If you know that, then you're ahead of the game, because likely everyone's going, oh, the dollar's moving, when actually, no, the yen's moving. And if you know that, you're ahead of the game. You know how to react in the other pairs, purely from watching what the crosses are doing. Anyway, any more questions, throw them up there. But in the meanwhile, Kay, you want to have a little look around, or you're still catching up?
I'm still catching up, but I want to take Catherine's.
Yeah, I was going to say, do you want to have a quick look at Euronoc?
Yeah, and maybe he can do a nice overview tomorrow, because we've already gone on for almost an hour.
Yeah. I'm just going to show the Euronoc for Catherine, and then that's going to be it for today. Where am I? I'm here. Hey, Catherine. Right, Euronoc is trying to break out, and I've seen. I had been watching this, and Again, I wasn't on yesterday, but I've been saying for a while that I think Noki is a little vulnerable, and it may be happening. So I would advise you to have a look at what's happening around 1083.5 to 10. Where is it? This other one here. Yeah, the top side of the whatever you wanna call it, channel wedge or so, or just a resistance line around 1086.5, 87. If we get and we are in the last day of the month, so take it into account. There may be flows that we haven't got a clue about that have to be done today. But know that Norges Bank is still. Oh, we should have had Norges Bank. Should we not have the flows today of the Norges Bank at 9 a.m.?
Yes, they're buying. They're now buying their currency, and they're buying at a bigger pace. So that's weird.
No, they're selling their currency at a bigger pace.
No, they were selling it for years and years, and now they've switched to buying it, right?
Really?
Let's have a look. Hold on.
Let me have a look. No, it will purchase foreign exchange and sell Noki. So they accelerate.
They accelerate the selling. Yeah.
They accelerate a little bit the Noki sales. So that may have weighed on it, together with what is happening in Brent, because Norway, you don't look at the US oil, right? If you want to know what Norway, the correlation with the Norwegian kroner is going to be European gas and the Brent. So yeah, both Brent are lower and Norges Bank selling a little more Norwegian kroner in February. I'd say be a bit careful if we get a close above this trend line tonight. See what happens tomorrow, but I'm not a huge fan of Norwegian kroner long right now, I must say, unless we start to close below here again, 1083. If we close below, then we probably are heading back towards at least 1070 and then maybe even 1060s. But keep a close eye on on where we close today, because it's looking a little bit dangerous for the Norwegian kroner out there. And that's really, with that, back to you. Bye.
Thank you, mate. Well, yeah, as I say, I hope all this has given you a good idea as to why crosses are important, why we should trade them, and that sort of thing. Now, if you want the best information about trading crosses, then obviously come and join us in the ForexAnalytix platform. As you can see there, prices are back to normal, but for all you lovely Forex Flow followers, you can still use my special discount to get 20% off the subscription for the lifetime of your subscription. I'll put the link in there with the code. Just use FFL20 and that will get you, as I say, 20% off as long as you hold a subscription there. And we trade the crosses, Kay's trading the crosses in and out like a whack-a-mole. And if you need any information on any part of your trading, we're here to help. We're in the room constantly. We're always available to chat to you and are happy to do so. So give us a look-see there. It's been a good show. Thank you very much to the lads, Stel and Kay, for your input, boys. It's very much appreciated, I'm sure.
Thank you. And thank you everybody for being here day in, day out. We really do appreciate you. I got a lump on my throat there.
You got tearful there. You got emotional.
Thanks, guys.
Yeah, thank you very much to all you viewers for coming to the show here, and we shall see you for FOMC Day tomorrow. Woo! Can't wait. See you later.
Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.